A director who moves from Canada to the US without filing corporate taxes can still be held personally liable for the company's unremitted taxes and could potentially face criminal charges and extradition for significant tax evasion. The move does not automatically release a director from tax obligations. Director's personal liability, joint and several liability. Under Canadian law, directors can be held jointly and severally liable for a corporation's unpaid taxes, including certain penalties and interest. This primarily applies to unremitted payroll source deductions, income tax, EI and CPP, and GST, HST that were collected but not paid to the Canada Revenue Agency, CRA. Corporate income tax. Directors are generally not personally liable for a corporation's regular income tax debt unless they received a benefit, such as a dividend, after the tax liability arose. Due diligence defense. To avoid personal liability, a director can use a due diligence defense by demonstrating that they took reasonable steps to prevent the failure to pay. This requires proactive measures, not passive reliance on others. Resignation. Simply resigning and moving does not immediately eliminate liability. The CRA can still assess a director for unremitted taxes for up to 2 years after their resignation. For the resignation to be valid and start the 2-year clock, it must be properly documented and recorded. Extradition for tax evasion. Criminal offense. Extradition from the U.S. to Canada is possible if the tax evasion is a serious criminal offense under both countries' laws. The Canada-U.S. Extradition Treaty allows for the extradition of individuals for offenses that are punishable by a minimum of 2 years imprisonment in the requesting country. Prosecution. The CRA can conduct a criminal investigation for serious tax evasion. If a prosecution is deemed to be in the public interest and there is a high likelihood of conviction, the case can be pursued. IRS reporting. A Canadian corporation with U.S. business activities or clients may have U.S. filing requirements with the IRS. This could include filing informational returns, and failing to do so can result in significant penalties. Moving to the U.S. foreign assets. When moving to the U.S., a director would be subject to U.S. tax laws and would need to report worldwide income. U.S. taxpayers must also report foreign financial accounts, FBAR, to the Treasury Department if the total value exceeds $10,000. Information sharing. Tax authorities in Canada and the U.S. have mechanisms such as tax treaties and information sharing agreements to enforce tax laws across borders.